A lot of newer agents focus on rate first, but in the field, loan type can shape the deal almost just as much. It affects down payment, mortgage insurance, seller concessions, property rules, and how competitive your buyer can be. If you can spot the likely loan lane early, you ask better questions, write cleaner offers, and bring the lender in before small surprises turn into contract problems. At the highest level, think in 4 buckets: government-backed, conventional, jumbo, and portfolio or non-QM. Government-backed usually means FHA, Virginia, or USDA. These loans follow program rules that can help certain buyers qualify with lower cash or more flexible credit profiles. Conventional is the standard conforming lane most people think of first. Jumbo is for higher loan amounts that exceed conforming limits. Portfolio and non-QM sit outside the standard box. They can work for self-employed, investor, or high-asset borrowers, but guidelines vary a lot by lender. Let's start with FHA. This is often the first stop for buyers who need a lower minimum down payment or have a more limited credit profile. The headline agents usually hear is 3.5% down, but the lender confirms the real fit. FHA also comes with mortgage insurance rules, including upfront and monthly costs in many cases. Seller concessions can be relatively generous, which is one reason FHA can help cash-sensitive buyers. The watch out with FHA is property condition. Appraisal and safety issues can matter more, so peeling paint, missing rails, or obvious repair problems can become part of the financing conversation fast. Now VA. For eligible veterans, active duty service members, and some surviving spouses, Virginia can be an outstanding option because typical structures may allow no down payment and no monthly mortgage insurance. That does not mean zero cost. There may be a funding fee unless the borrower is exempt, and the lender still reviews income, credit, and residual income standards. But for the right buyer, Virginia can be extremely strong. USDA is another owner-occupant option agents should know. It is designed for eligible rural and some suburban areas, and the headline is often no down payment for qualified buyers in the right location. Then there is conventional. Typical minimum down payment can start low for some primary residence buyers, but many people associate it with stronger credit, cleaner property situations, and more flexible long-term options once mortgage insurance can be reduced or removed under the lender's rules. Jumbo usually means the loan amount is above the conforming limit for that market. In practice, that often means stronger reserve requirements, tighter underwriting, and more scrutiny on income and assets. Portfolio loans are loans a bank or lender may keep on its own books instead of packaging into standard agency guidelines. That can create flexibility, but it also means one lender's yes may be another lender's no. Non-QM is where agents hear terms like bank statement, DSCR, asset depletion, and interest only. These are not magic shortcuts. They are specialty products built for borrowers whose profiles do not fit standard boxes. For example, a self-employed buyer may use bank statements instead of tax returns. An investor may use DSCR, a high net worth retiree may use asset depletion. The exact rules are always lender specific. Your job is not to qualify that borrower on the spot. Your job is to recognize the lane, avoid saying no too early, and connect them to the right lender fast. When you talk about down payment, use words like typical, common, or often. That keeps you accurate. Say something like FHA often starts at 3.5% down, and conventional can vary depending on the buyer and program. Do the same with seller concessions. Instead of promising a seller can cover everything, say the allowable amount depends on loan type, occupancy, down payment, and lender guidance. That matters because concessions can affect cash to close and offer strategy. A buyer with solid income may still need help on upfront costs, and the right loan structure changes that conversation. Also, avoid risky shorthand like ninja or no doc unless you are specifically quoting a historical term and explaining it carefully. Those labels are outdated, loaded, and easy to misuse. A better script sounds like this. There may be specialty programs for self-employed or non-traditional income borrowers, but the lender will confirm qualification details. That is how you stay helpful without drifting into lender territory. You frame the option, the trade-offs, and the next question. Then the lender handles the exact approval. In the field, start by identifying the buyer's lane. Are they first-time, military, rural area eligible, move-up, luxury, investor, self-employed, or asset-rich but income-light? Then match that profile to the likely loan bucket. Not final answer, just the most likely lane so your questions get sharper. Before you write, ask the lender for two things in plain English: real cash to close and any property red flags that could matter for this loan type. That helps you catch issues early, like condo eligibility, condition concerns, reserve requirements, or whether concessions may be important to make the numbers work. And when you present an offer, think bigger than rate. Financing is a strategy. The right loan can make a buyer safer, more competitive, or more realistic about which homes to pursue. The big takeaway is simple. Loan choice is not just about rate. It shapes cash needed, insurance or fees, concessions, property fit, and the buyer's whole strategy. The agents who close cleaner deals are the ones who recognize loan fits sooner, speak accurately at a high level, and bring the lender in early for the exact numbers.